in order to get past a lot of emotion or a lot of, I guess, your seven deadly sins, right? Experiencing greed, you're going to need to develop a different type of psychology on the market. So when we speak of this psychology, for me, I like to think of the market in war, and I like to think of the market in a game. So in order to get rid of greed, right, that word is not in my vocabulary if I think of the market as a game. I'm not taking the trade for the money that I'm going to achieve out of it. Instead, I'm taking it from a point of entry to price targets, right? So like you described, we have three different variants of price targets. You know, the first one, the second one, and the third. Price targets are not necessarily meant to be like a high score. It's supposed to be thought of the model that you're experiencing, right? So when a trade goes from entry point to first price target, it doesn't mean you just hold it to try to get to 2 and 3. It just means that, are you educated enough on this model past this point? If you're not educated enough on the model past this point, then there's no reason to stay in the trade. That was your trade, so you should get out. Now, that takes away greed because the trade wasn't necessarily about the money. It was about getting from entry point to first price target. When it comes down to getting to the second and third price target, that depends on market condition, right? So if you're educated in the models, then you would know what conditions would be needed in order to stay in that trade. See if it holds price target 1 to go to price target 2, or if it rejects price target 1 to get some kind of re-entry, and then you can target, price target 2, get back in the trade with the profit you initially made. That way you're not seeing a trade go up to $1,000 and then come back down to zero, and now you're only thinking about, I was up a band, I should have got out, but now if I hold the trade, I could probably see price target 2 instead of it failing at price target 1 again, right? Now you're putting yourself in a bad spot. So developing that kind of psychology in order to help, right? So if we use phrases, for me in the game or the psychology, phrases help a lot. So for me, one of my phrases is, if it gets to price target 1, I like to shave, right? So I'll take, if my entry is 10 different contracts, then I'll split them up into 3 different trades. So the first price target is majority of my position. More than half needs to go off at price target 1. And then I'll have, for example, if I had 10, I would sell 5. Now I only have 5 invested in the trade. If that 5 comes back to break even, then I should have at least profited what the first 5 has given me. And then if it gets carried to the next price target, then I'll get rid of half again. Can't get rid of 2.5, so maybe I'll sell 3 and keep 2 if the trade looks kind of iffy, or if the trade is really good, then I'll sell 2, keep 3, right? So that variation helps a lot. So I think in order to counteract greed or a lot of things that we try to label on ourselves, it's best to fit the psychology on the market, so that way you ask yourself the right questions in order to stay in trades. The way I like to think about it is phases. So there's, let's say, 3 different phases of your trading journey, right? So if you're starting a new funded account, then this is the first phase of your account, right? You're not funded or anything. You only have a certain amount of contracts you can use, so you can only use 3. So if that's the case, your goal is not to experience an entire model, meaning going to price target 1, 2, and 3. Your goal is to just use those 3 contracts, find the best entry you can with the 3, and you want those 3 to get to price target 1, because that's going to be a pretty decent amount of money. So if we're talking about a funded account, right, you're using $100,000, you're trying to make $6,000. From where you get your entry to where we're expected price target 1 to be, that should be around $1,000 with 3 contracts. You know what I mean? So we're talking like what, $325, $350 per contract in order to experience $1,000, right? So that trade is pretty small, it's pretty micro, in order for you to achieve $1,000. So that means 6 trades should technically get you there, assuming you don't have any losses, but that's not feasible, right? So for the first phase of your journey, you're just looking for that one trade you can take all the time that would practically guarantee you an entry and price target 1. Because most of the time you can get that trade, it's after price target 1 that you'll experience a lot of the pushbacks, right, and the stop loss chases and things like that. So if you're anticipating too much, you'll experience a lot more losses than you would if you just educated yourself enough to just go from entry point to price target 1, and you'll have a lot more confidence to stay in the trade when it's not necessarily going the right way or adding into that position. But moral of the story, master price target 1, right? That's a small trade. And if you can master that trade, you can replicate that trade multiple times in a day, which means that trade should be $1,000. So 6 trades. If you can take that 6 trades spanned across an entire week, you can have a funded account in a week. You know what I mean? Depending on how the journey goes. But your losses should not determine whether your account just disappears, right? That's not how the trade should go. So managing your risk accordingly. If you master that trade, you don't have to experience losses. A lot of people always ask me like, well, how much are you risking on this trade? But it's like, you don't necessarily have to risk anything. If your model gives you the right entry point and it does experience that low, you just cut it for what it's worth. There's no real allocation of money. You know what I mean? And if you scaled properly, you're only putting one contract in. If it goes down a little bit, you're talking $25, $50, maybe $100 loss. You know what I mean? But it's not really a loss if it's just entries until you get the right move, and then that loss would be made up immediately for the trade. So the trade's not a loss, just the entry that you're kind of finding your footing in is the loss. But I don't consider it that way. Emotion is very difficult on the topic of trading because technically you're not really supposed to feel emotion if you're trading a particular model, right? But as a beginner trader, emotions are inevitable because obviously you're attaching your actual senses to the experience that you're experiencing. So for you getting into a trade, whether it's your first time or your 100th time, if it's always done one thing, you always try to anticipate that sort of feeling, you know? So every trader's emotions are going to be very, very different. So there's a lot of different variants of how you feel. But sticking on the topic of our strategies personally, the only way you should experience emotion in that manner, because I used to do the same, was if you're trying to anticipate the bottom of a trade, then you're getting in, it goes down a little bit, and then you're like, oh man, maybe this is not the bottom. And then you cut, and then it goes up, and then you're like, oh man, that was the bottom. So now you're rushing to find an entry, you know? And you can see how this is like a chain reaction, right? Because you tried to anticipate, now you see it run, which makes you feel like FOMO, right? Fear of missing out on the trade. So now you're chasing the trade, but now chasing you leads to getting a really high entry. So even though it didn't come down to technically where your stop loss would really be, you got a high entry. So now even though it's just operating, you're down on that position. And if you're down on that position, then you're thinking only about, well, I just took a loss trying to anticipate it. Now I'm going to cut for a loss during the trade, right? So all these things, again, it's just chain reaction. So in order to intercept your emotion, you need to understand what chain reaction is causing this type of emotion and then build a counter psychology to it. So for me, I developed the 1, 2, 3 idea, and that is my counter to my old philosophy. So before, I used to try to target the bottom, and I would get in on the 1, right? We're talking about the 1, 2, 3 trend line. I'd get in on the 1, it goes up, I'm like, oh dude, I'm going to hold this trade, this looks really fire. And then it comes down, stops me out. But right after it stops me out, it bounces again. So that was the second touch. And then I'll get in and I'm chasing the trade. Now the second one drops down and goes below again. And now I'm fed up. I'm frustrated. I'm like, bro, I get in the first time, it goes up, comes down and gets me out. Okay. Second time, try it again, comes down and gets me out. Do you really want to try this for a third time? It's like human psychology, right? The person did it twice. He's like, nah, the third time is just gonna ruin it, right? You already took 2 losses. So now you don't get to participate in the third. And that third touch is the last touch. And then after that last touch, it does the run, and then it tests that area a few times, and then it blasts off and never comes back, and then you're like, bro, that was the trade. So my counter psychology to my old habits was to just build the 1, 2, 3 and only touch the trade if I get a 1, 2, 3. Oftentimes, a 1 and a 2 might happen, and I don't get a third. But I didn't have to put myself through that kind of frustrating chain reaction for me to feel those kinds of emotions because of the thing that I developed in order to help me. So for you, if you're experiencing that same thing with my strategy, you would build a philosophy or a counter philosophy within the strategy to help you find your best entry based off of what you're experiencing the most. Because if you're feeling that same chain reaction often, you're probably experiencing the same event often, which means it probably has characteristics that you can identify. And the faster you can get into the intercepting of it, you'll be able to clear that up for yourself. And then that will literally just take you from losing every time to winning every time. And then that's just a whole evolution in trading. So yeah. So the projecting tool is literally just a visual safety net. You know, because you lack accuracy, you'll want the visual safety net, which means that you don't know exactly where you want to get in, but as long as it doesn't leave this area, then you should be all right, right? That's a counter psychology we developed for the 936 strategy, and it helped for a lot of people. So although it helped in that specific strategy, which is a 936, it doesn't necessarily exist on a lot of other different strategies. So you would still need to develop that type of psychology for something in the market hours, because I'm sure the market hours is probably where you experience most of the stop loss chasing, right? Unless you're just not following the rules for the 936, because you're supposed to wait for certain levels, and if you don't, it's probably going to keep stopping you out until it gets there, you know? So in order for us to do something like that, again, we just need to identify where's the chain reaction coming from, what is the thing that you're experiencing the most, and then we can develop like a better psychology with whether it's like real tools for visuals or whether it's just some kind of sayings that you can repeat to yourself. If I get this, then I can do this kind of experience. With the first question, right, us turning it into a different type of philosophy, right, gamifying the experience. When you gamify it, right, for me, I think about when you're fighting a boss on a game. It's a robot, it's programmed to do one thing over and over all the time, but like the first time you fight this dude, you have no idea what it's capable of. But the 10th time he's destroyed you, you go in there and you're like, okay, he usually does this, and then he does this, then he does that. And then you kind of develop a way of fighting around this individual. Same thing goes with the market. Like, it literally is presenting the same moves all the time. It might be on different parts of the trend, but it's doing it all the time, and it only has a certain rotation of moves. But it takes time for it to perform each. So to you as a new trader, it might take you a whole year to experience all of the market's variance of the moves. But over a 10-year horizon, you're experiencing the same 1 year amount of moves 10 times each for 10 years. So you would be really good at fighting the market if you gave yourself that kind of timeline in order to be successful. But because you're in your first year of experiencing it, you're going to get hit with new stuff every now and again, which is okay, right? Because it's just a lesson. But you can't let those lessons disappear by not writing down what characteristics are you experiencing that has happened to you, because if it happens again, it will get the best of you. And if you keep falling victim to the same moves, that's where your weak point will be. So if you're participating in every part of the market, there's always going to be new stuff. But if you're participating in the area that you know best, which means the characteristics, right? To give you an example, perfect retracement, right? Perfect retracement, we need a really big drop on an emotional move and a 1, 2, 3. If we get the big drop and an emotional move, right, and then you have that 1, 2, 3, that's the characteristics for the perfect retracement model, and that would allow us to take that trade every time. But without those conditions, we don't know what trade we should be taking. So you can't just put those same characteristics on a random part of the chart. They don't exist that way, you know. So that's why we make the models, so that way you can pick one, study one, and be like, okay, this is the one I'm going to use. And this will allow you to at least develop market experience with that strategy and find confidence, understanding that there is something out there that you'll be able to study and actually make work and actually make money off of over the longevity of a year, instead of being a trader who is looking for a trade every hour of the day, every day for the whole month, right? Because that's not technically how trading works. So if you're trying to make a certain amount of money a month, certain amount of money a day, or finish off the year a certain way, the strategy needs to fit. And if you keep forcing trades every single day and you haven't studied for that strategy, then you're more than likely going to experience a lot more losses than W's. The funded account ideology was developed because, for me as a trader, I would invest my own personal funds into an account. So whenever I lost a trade, I would lose as much as that trade costs, right? When you're trading a funded account and you lose $1,000 today, you didn't actually lose $1,000 of your hard-earned money. You didn't actually lose $3,000 of your hard-earned money, right? So you're getting losses at a very big discount. The price of the funded account is like $50, max $150, right? So the losses that you're experiencing with $1,000 and $3,000 losses, you're getting them for the fraction of the price, $50, $100. Funded trading is not the goal to be able to be free, financially free, or become a trader. It's to acquire the lessons of trading for a fraction of the price that a regular trader would if that didn't exist. So for me, going in debt and getting a lot of paychecks spent on the market, I took it as education, and that put me in a really big hole psychologically. And it was very hard for me as a trader to learn a lot of these things when I obviously have bills to pay and I can't afford to keep trading. But $50 at a time, you can lose 10 accounts. You're only knee deep $500, right? So when it comes down to funded trading, just because you lose the account, it shouldn't be looked at as a bad thing, because you've been able to acquire lessons at a fraction of the price. And if you take it from that headspace, then you'll be able to actually put the efforts and the lessons that you're accumulating here to actual money in the trading world. Understand that funded trading is very difficult because you're trading in the confines of parameters, meaning you only have a certain amount of money to lose and they kick you off. In real life trading with your own money, you got until it hits zero. So however much money you're willing to risk on your trade, that's how it's going to work. But you need to know that you have a model that works. So for my strategies, I know it's going to turn around. I just don't know where the bottom is. That's why it's very difficult on funded trading. But if it was real money, when it's real money for me, I can buy there and I know it's going to turn around somewhere around here. So I'm not too worried about it because I know I have this much room to experience this kind of loss. Or if I buy something, like for example in options, I can put the money in there. Maybe my contracts go down to zero, but the moment they come back up, they're back making money again. So I never had to worry about the trade, if that makes sense. So moral of the story, and long story short, is funded trading should be not taken as the end all be all, and losing an account is not the end. It's actually the beginning. You're literally acquiring the lessons you need to become an actual trader. So you need to lose a lot of accounts. Like, it should be looked at as a good thing, because these are reps. And the more reps you get, the more you'll be able to realize that when this chapter closes and you get your funded account and you get your first payout, you might actually be good at trading. And that means you might actually be able to use your own money, and it'd be a lot better. It's free, right? There's no shackles, there's no weight, there's no rules. It's literally your money, your trade, however much you want to risk. And when you have that much freedom and you're used to being trading in the confines of funded trading, then you'll be able to really make some leaps and bounds. So just take it as lessons more than it is a financial liability. And if you feel as if it's expensive, then you need to ask yourself, or get real with yourself, one of the two. Is it worth it? Or are you actually getting this for a fraction of the price? Should I go try this with my own money? Yeah. So chasing trades, right? If you're anticipating the entry, then that means you must have an idea of what the bigger picture is looking like, right? Because if you're anticipating the entry, then that means you really want to get in right here because you deem this to be a valuable point of entry. You'd expect the market to just grab it and start going the other way. There has to be some criteria that is leading you to that ideology. So if the market is in a position that is, you are looking at it and saying, okay, this is where it turns around, you can't keep trying to buy it as it's continuing to push into that area. I like to think about it as a car that's going really fast, right? The car is going really fast. If it hits a wall, sure, car is not doing nothing to the wall. But the market isn't really designed in a manner of having a wall, right? It needs to slow down. So oftentimes when I think about the market, I think of a car going really fast on a drag race, and then they let the parachute out, they put the brakes on. So there's a lot of different stoppages that it needs to touch first before it can turn around. So if you think about it like that, you won't be in a rush to just see the market immediately turn around and try to just get the best entry. There has to be criteria that is in that turnaround point, the slowdown and the turnaround. So what I like to call it is the slow before the pop. right? So if you're anticipating, you're expecting it to turn around eventually, but it needs to slow down first before it can actually pop. So if you're buying the slowdown, then you're just giving away money. So then when the pop is actually coming, you have to get in, and that pop is now making back all the money you spent trying to catch the slowdown, which is it's backwards, and it's a lot more effort, right? So in order to stop anticipation and actually get really good entries is letting the market do the slowdown. And then the slowdown, what does that mean, right? So a slowdown is when the market is running straight to a level, and then you start to see the candles and the lows become a lot closer than they used to be. So you'll see one big drop, but then the next candle, you'll have a smaller drop below that one, and then the next reach goes below that one, right? And it's like they're not drastically far away from each other. They're all generally in the same area. That means that the market is slowing down, right? You're not getting any big drops. So that means it cannot drop until it gets more money to get another dump. So you'll be very safe, again, with the ideology of finding that entry and taking it to price target 1 if you wait for the slowdown first and let it show you that it's ready to go up, rather than you just trying to get in estimating that it's going to go up, because then you're going to put yourself in a position of a loss, and then the move is just going to be paying for the losses that you experienced because you were too impatient. And if that doesn't hurt enough, then you'll have to sit there repeating the same exact thing over and over again until you sit down with yourself and realize how much money did you give away in the anticipation, how much money did you make after the anticipation, and if you add that up amount on how many times you've ever done that during your whole trading career, you'll see that you may have lost 10 grand and made back 10 grand the entire time.